Recession talk is everywhere, and if you're just getting started with investing, it probably feels like the worst time to jump in. But here's the thing, timing the market won't make you rich, but knowing what holds steady will. Most beginners hit pause during a recession, but that's exactly why they miss the biggest gains, because some investments aren't built to survive downturns. They're built to thrive in them. In this video, I'm breaking down 3 recession-resistant ETFs, what they are, why they work, and how to use them to build a portfolio that keeps showing up even when the economy doesn't. I've helped thousands of new investors build confidence in any market, and these are the exact funds I would say when people ask, what actually feels safe right now? Welcome back, Rich Chicks, or if you're new here, I'm Taylor Price, and this is Priceless Tay.
Money expert Taylor Price,
founder of Priceless Tay.
If you started investing in 2020, you would have doubled your money by investing in the S&P 500 to 2025.
Yeah.
The money talks, not just me. We want people to thrive, not just survive. If you're ready to start investing, start with Priceless Tay.
Before we dive into the first one, let's make sure we're all on the same page, because if you're new here, you might have heard the term ETF, but not really gotten it before. So real quick, an ETF for short is exchange traded funds. It's like a bundle of stocks you can all buy at once instead of picking just one company. You get to buy a bunch like Apple, Walmart, Microsoft, all together in just one click. Think of it like this. You could go aisle by aisle picking out groceries, or you could grab a pre-filled bag with everything you need. That's what an ETF is, a ready-made portfolio in one move. And why does it matter? Because it spreads out your risk. If one stock underperforms, the others help balance it out. So you're not putting all of your money into one shot. And that makes investing way less stressful. So now that you know what an ETF actually is, let's get into the ones that don't just survive in a recession, they lean into it. Rule number 1, invest in what people can't stop buying. Let's start with the ETF that kept delivering even when the world felt like it was falling apart. Here's the deal. Banks started giving out some risky home loans to people who really couldn't afford them. Wall Street took those loans, bundled them into investments they claimed were safe, and sold them everywhere. When borrowers started defaulting, those investments collapsed, and one of the biggest banks on Wall Street, Lehman Brothers, went bankrupt. That was September 2008, and it triggered full-on panic. Credit froze, stocks tanked, people lost their jobs, homes, and retirement savings literally all overnight. The crazy part, while the S&P 500 dropped about 37%, XLP fell only around 15%, less than half the damage. Because even in a meltdown, people still buy soap and snacks. The demand doesn't go away. You've even seen this in 2020 during COVID when toilet paper was still getting bought up in hordes and going out of stock. And it gets better. XLP pays out dividends, and it's been raising those payouts for 12 years straight. As of 2025, it's got a yield of around 2.5%, which means even during a recession, this ETF literally pays you to hold it. It's not a get-rich-quick fund. Absolutely not, for sure. It's a stay rich quietly in the background kind of fund. Up next, the ETF that gets stronger every time somebody books a doctor's appointment. Rule number 2, bet on what doesn't get canceled even in a crisis. This is the ETF that keeps working when the world hits pause because healthcare really isn't an option. IHF holds the companies that literally keep people alive. United Health, Cigna, CVS Health. These aren't just brands. They run hospitals, insurance plans, and pharmacies. And here's the thing, no matter what the economy is doing, people don't skip out on chemotherapy. They don't cancel surgery. They don't stop managing chronic illness. Most people think healthcare ETF means pharma or biotech, high risk, high drama, but IHF is different. It focuses on healthcare providers, the companies that deliver care and bill insurance. Less hype, more really about stability. These are the businesses that still collect revenue even when everybody else is tightening their budget. This fund is built around consistency. Whether you're insured through your job, Medicare, Medicaid, or a private plan, someone's getting paid. IHF gives you exposure to the companies behind that system, and most of them have been cash flowing for decades. And the consistency hasn't gone anywhere. Even in recent years, through COVID, inflation, and market volatility, healthcare providers kept delivering stable revenue and long-term demand. In 2008, as we just recalled, while the S&P 500 dropped around 35%, the healthcare sector showed up very differently. Most industries were shedding jobs, but healthcare, it kept hiring. During the Great Recession, when unemployment hit 10%, this sector continued creating jobs, proving how non-negotiable healthcare spending really is. And the numbers weren't just about stability, they showed upside. Academic studies found the healthcare sector produced positive abnormal returns of 10.7% to 22.3%, averaging 16.5% during key crisis windows. The translation here, while the market was panicking, healthcare investors were holding and sometimes winning. While IHF isn't a dedicated dividend ETF, many of its top holdings like CVS and United Health pay reliable dividends. So in a downturn, this fund gives you something rare, defense plus income. This is why healthcare is often called a defensive sector. It's where the money keeps moving even when everything else starts to slow down. So now we've covered what people always need, daily essentials like toilet paper and healthcare. But what about the companies that don't just survive tough markets? They reward you for staying calm through them. Let's talk about the ETFs that literally pay you to hold the line. Rule number 3, choose companies that pay you to stay. This ETF just doesn't survive in downturns, it pays you to hold through them. VIG is made up of companies that have increased their dividends for at least 10 years straight, not just paid them, raised them. Some have been doing it for 25, even 40 plus years without missing a beat. That means they've consistently paid out more cash to their investors through recessions, inflation, layoffs, and market chaos. We're talking about adult money behavior here. Microsoft, Apple, Johnson & Johnson. These companies don't just show up, they level up. Most beginners chase high yield stocks, but high yield doesn't always mean high quality. VIG is different. It focuses on dividend growth companies that raise payouts consistently without overextending. These are mature, reliable businesses with strong balance sheets and steady profits. If they're increasing their dividend year after year, it means that they've got a surplus of cash and the discipline to share it. In a recession, growth slows, prices drop, hype dies, but companies in VIG, they keep sending you money just for holding their stock. That's income you can reinvest, stack, or keep as a cushion when other parts of your portfolio are dipping. And if you do reinvest those dividends, you're compounding. You're using today's earnings to build tomorrow's gains. Even a few dollars makes a difference because now your dollars are hiring more dollars. From 1973 to 2023, dividend growers and initiators returned 10.24% annually, compared to just 7.65% for the broader S&P 500. And they did it with a smoother ride. Why? Because they don't rely on hype cycles. They rely on financial discipline and decades of proof. So you've seen how these ETFs hold strong when the market gets shaky. It's about building a portfolio that actually reflects that. Go to beginner.money when you're ready to put structure behind what you're learning and make your first move count in my coaching program. So here's the bottom line. If you're nervous about investing during a recession, you don't need to time the market. You need a system, a strategy that actually holds its ground when the economy gets shaky. That's what these 3 ETFs and these 3 rules give you. Which of these ETFs feels like a starting point for you, the one that you'd actually add to your portfolio? Drop it in the comments. I want to hear how you're thinking through this. And if this helped you shift how you're approaching investing during a downturn, like this video, share it with somebody who needs to hear it, and subscribe, because this is how we build wealth that lasts. I'll see you in the next video. Peace.